From the simplest investing decisions to managing millions or even billions of dollars. In today's video, we'll break down the 7 levels of investors, from beginner to expert. You'll discover where you stand right now, and more importantly, what it takes to move up to a level where you feel confident, in control, and growing your wealth on your own terms. High-interest debt payer. Wait, does this even count as investing? Well, kind of, but not in the way you'd expect. If you're stuck with high-interest debt, like credit cards or payday loans, you're not building wealth, you're actually moving backwards. But here's the surprising part. Paying off that debt might be the smartest, risk-free investment you can make. In fact, in some cases, it can give you better results than the stock market. Now, just to be clear, I'm not saying taking on this kind of debt is a good idea. It's definitely not. But if you already have it, the best move you can make is to pay it down as fast as possible. We're talking 8% interest or more. That's super high. You might pay hundreds, even thousands, just in interest every year. And why paying off that debt is almost always better than investing. Imagine you have a credit card charging you 15% interest. That means for every $100 you owe, they charge you $15 every year. Now let's say you also have $1,000 to invest. If you put it in the stock market, you might earn 7 to 10% a year. But you're still losing money overall because your debt is costing you way more than your investments are earning. And remember, every dollar you use to pay interest is a dollar you're not investing. That's called opportunity cost. Instead of growing your money, you're just handing it over to the bank or credit card company. So in most cases, the smartest move is to focus on paying off that high-interest debt first. It's like getting a guaranteed return. Paying off a 15% interest loan is like earning 15% on your money, risk-free. Then you can start thinking about saving and investing. But first, get rid of the expensive debt. Build an emergency fund. And then you will be ready to start investing. So yeah, this is truly the first level of investing. Congratulations! If you're at level 2, you've climbed out of the debt hole, but now you're playing too safe. Your money's secure, but it's barely growing. These kinds of investors usually keep their cash in savings accounts, money market accounts, or maybe even a certificate of deposit. They don't like taking big risks, so the idea of putting money into the stock market, where it could go up or down, might feel stressful. For them, it's more important to protect what they have than to chase big returns. But here's the downside. Even though savings account interest can sometimes beat inflation, other times it just keeps up with it, and often it falls behind. It really depends on where we are in the economic cycle. If you're a saver, it means you're disciplined and have built a stable financial situation. The next step is simply realizing that, over the long run, taking on a bit more risk could help your money grow in a much bigger way. And that brings us to the passive investor, the one who keeps it simple but smart. This person puts their money into broad market index funds, or ETFs, like the S&P 500 for the US, or total stock market funds like the MSCI World. They're not trying to pick the next Amazon or Apple. They are not even timing the market. Instead, they're betting on the long-term growth of the entire market. They understand something powerful: diversification and compounding. By investing in a wide range of companies, hundreds or even thousands at once, they spread out their risk. If one company struggles, others can balance it out. They also know about compounding, the idea that your money earns interest, and then that interest earns more interest. It's like a snowball rolling downhill, getting bigger the longer it rolls. Most passive investors use a set-it-and-forget-it strategy. They invest regularly, maybe monthly or with every paycheck, and they don't stress over short-term ups and downs. They follow the mindset of people like Jack Bogle, the founder of Vanguard, who believed in keeping fees low and staying the course. Doesn't require a lot of daily effort or deep market knowledge, but it works, especially over 10, 20, or 30 years. And guess what? This kind of passive investing often outperforms active strategies, even the ones we'll see at the higher levels. Next on the list is what I call the do-it-yourself investor. This person doesn't just stick to index funds. They might own a few ETFs or mutual funds, sure, but they're also picking individual stocks. Maybe they've got shares of some smaller companies they've researched on their own. They keep an eye on the markets. They follow financial news, maybe watch CNBC or read investing books and blogs. They're not experts, but they're learning and they enjoy the process. Do-it-yourself investors often do some basic analysis before buying. They might look at a company's earnings, growth potential, or what analysts are saying. But they're still learning how to separate real value from hype. One thing to keep in mind: buying individual stocks comes with more risk. If one stock tanks, it can drag down your portfolio. That's why many smart do-it-yourself investors still keep a solid core of index funds or ETFs to stay diversified while exploring stocks on the side. Even with all that effort, it's pretty common for passive investors to end up with better returns. Next up, we've got the advanced investor, the one who really knows their stuff. This person goes beyond just buying index funds or picking a few popular stocks. They're digging into financial statements, reading income reports, cash flow statements, balance sheets, and actually understanding what it all means. They're looking at key metrics like PE ratios, return on equity, debt levels, and more. They use this data to figure out whether a stock is fairly priced or overhyped. Advanced investors often manage a diversified portfolio, but unlike passive investors, they adjust it more actively. If they think a stock is overvalued, they might sell it. If they see a great opportunity, they'll buy in. They're always looking for the right balance between risk and reward. They might use valuation models like discounted cash flow or comparables. It's not easy stuff, but for them, it's part of the strategy. This type of investor treats the market like a business. They don't panic when stocks drop. In fact, they often see downturns as buying opportunities. But it's not about being perfect. Even advanced investors make mistakes. If you're an advanced investor, you've probably put in years of effort, study, and experience to get here. And again, even at this level, it's not uncommon for passive investors to outperform you over time. Now we're talking about the portfolio manager. This person isn't just managing their own money. They might be managing portfolios for clients, a family office, or even mutual funds, which are the ones we will focus on. We're talking big portfolios, often in the millions, and every move is calculated. They're not just buying and holding. They might be using advanced strategies like options, hedging, tax loss harvesting, and even managing currency or interest rate exposure. Think about someone like Peter Lynch. He's a classic example of the portfolio manager mindset. He used to dig deep into entire businesses, focused on long-term value, and made decisions based on careful research and discipline. In one of his books, Lynch mentions how during vacations, he'd often meet with CEOs of companies he was interested in, just because they happened to be on his way. Like Buffett says, the stock market is a device for transferring money from the impatient to the patient, and portfolio managers are the most patient and prepared of them all. Finally, we reach the capital deployer, the top of the investing pyramid. We're talking about someone handling serious money, making big decisions that can impact whole companies and sometimes even the market as a whole. Capital deployers operate in the world of private equity, venture capital, hedge funds, or institutional investing. They're not buying a few shares of stock. They're writing multi-million-dollar checks to fund startups, acquire companies, or back large real estate deals. By injecting capital, they can help a small company scale, turn around a struggling business, or help startups get big enough to sell shares to the public for the first time, what we call an initial public offering. Warren Buffett, apart from portfolio manager, works at this level too. His company, Berkshire Hathaway, buys whole businesses like Geico and Dairy Queen. They don't just invest, they help these companies grow and get better over time. It's a big leap from regular investing. Here, it's about controlling outcomes, managing risks on a huge scale, and thinking years or even decades ahead. And that's it for today's video. Comment below in the comments, in which level are you? And what's your goal in the future? Also remember, these levels are my own way of explaining things, so they're not official or set in stone.